This is a Treasury bill, a short-term loan to the United States government, the safest asset in the world, according to every textbook ever written about finance, the foundation of the global monetary system, the collateral that backs trillions in overnight lending, derivative contracts, and institutional cash management. When you buy a Treasury bill, you're not really buying a piece of paper anymore. You're buying an entry in a database, a digital record maintained by a system called the Depository Trust and Clearing Corporation, the DTCC. Every treasury, every corporate bond, every mortgage-backed security in America clears through this single institution. $2.4 quadrillion in transactions annually, the invisible infrastructure that makes modern finance possible. On January 19, 2026, at 11:47 p.m. Eastern, the DTCC reported a settlement failure rate of 4.2%, the highest since the system began tracking in 1995. 4.2% of all securities transactions failed to settle on time. In a system processing $8 trillion daily, that's $336 billion in failed trades, in a single day. The financial press didn't report it. The failure wasn't dramatic enough for headlines. No bank collapsed, no exchange halted. The system simply lagged. Transactions that should have completed didn't. Securities that should have moved didn't move. And $336 billion in expected payments didn't arrive when they were supposed to. This is not a story about one bad day. This is a story about $18 trillion that has been quietly repositioned over the past 6 months, moved from visible balance sheets into shadow structures that the DTCC cannot fully track. When you understand where that $18 trillion went and why, you'll understand what the 4.2% failure rate is actually telling us. The credit markets are about to freeze, and almost nobody sees it coming. Here's what they're not telling you. The modern financial system runs on collateral, not money, collateral. When Bank A lends to Bank B overnight, Bank B doesn't just promise to repay. Bank B posts collateral, usually Treasury securities, that Bank A can seize if repayment doesn't arrive. The collateral makes the loan safe. The loan makes commerce possible. The cycle repeats trillions of times daily, lubricating every transaction from corporate payroll to international trade. The problem is that collateral has become scarce. Not because treasuries don't exist, the U.S. has $34 trillion in outstanding debt, but because the treasuries that exist are increasingly encumbered, pledged, locked up in structures where they can't be freely used as collateral for new transactions. There are 3 main sinks where collateral disappears from the available pool. First, the Federal Reserve's reverse repo facility. When the Fed conducts reverse repos, it takes treasuries from the market and gives banks cash in return. Those treasuries sit on the Fed's balance sheet, unavailable for private sector collateral use. The reverse repo facility currently holds $1.8 trillion in securities, down from $2.5 trillion at its peak, but still an enormous drain on collateral availability. Second, the Treasury General Account, the government's checking account at the Fed. When the Treasury builds up its cash balance, as it does before debt ceiling standoffs or major spending needs, that cash comes from selling securities to the market. The securities enter private hands, but the cash sits idle at the Fed rather than circulating. The TGA currently holds $740 billion, $740 billion in purchasing power removed from the system. Third, and this is where the $18 trillion comes in, private collateral transformation through the shadow banking system. This is the mechanism that almost no one outside institutional finance understands, and it's the mechanism that's about to break. This is where the lie becomes unsustainable. Shadow banking isn't illegal, it isn't even hidden. It's the system of non-bank financial institutions, hedge funds, money market funds, insurance companies, pension funds, that perform bank-like functions without bank-like regulation. When a hedge fund wants leverage, it doesn't go to a traditional bank and apply for a loan. It enters a repurchase agreement, a repo. The hedge fund sells securities to a dealer with an agreement to repurchase them tomorrow at a slightly higher price. The difference is the interest rate. The securities are the collateral. The transaction is, economically, a loan, but legally and regulatorily, it's a sale and repurchase, which requires less capital and faces fewer restrictions. This is how leverage builds in the shadow system. The hedge fund uses repos to multiply their purchasing power. The dealer uses the securities they received as collateral for their own borrowing. The counterparty to the dealer uses those same securities as collateral for yet another transaction. A single treasury bond can back multiple layers of lending simultaneously, a process called rehypothecation. In theory, rehypothecation is limited. Regulations cap how many times the same collateral can be reused. In practice, those limits apply only to regulated entities, and over the past 3 years, an enormous volume of collateral activity has migrated to entities and jurisdictions where the limits don't apply. $18 trillion has moved into what analysts call the collateral shadow, structures where the same securities are pledged multiple times to multiple counterparties through chains of transactions that span multiple jurisdictions. Cayman Islands hedge funds lending to London prime brokers, lending to Singapore family offices, lending to Dubai wealth managers. Each link in the chain uses the same underlying collateral. Each link believes they have a secured claim. When the music stops, they'll discover there aren't enough chairs. On November 14, 2025, at 3:30 a.m. London time, the Bank for International Settlements published a working paper titled Collateral Velocity and Systemic Fragility in Non-Bank Finance. The paper received almost no media coverage. It should have been front-page news. The BIS found that collateral reuse rates in the shadow banking system had reached 7.2x, meaning the average high-quality security is pledged 7.2 times simultaneously. In 2015, that rate was 2.8x. In 2007, before the financial crisis, it was 3.1x. We are running the financial system at more than double the collateral leverage that existed before Lehman Brothers collapsed. And the collateral chains are now longer, more international, and less visible to any single regulator. When settlement failures spike to 4.2%, it means someone in those collateral chains didn't deliver. And when they didn't deliver, their counterparty couldn't deliver. And when their counterparty couldn't deliver, the next link failed. Dominoes falling in slow motion, showing up as a statistical anomaly in a DTCC report that nobody reads. When collateral chains break, credit freezes instantly. The mechanics of a collateral-driven credit freeze are different from a traditional bank run, but the outcome is the same. In a bank run, depositors lose confidence and withdraw cash. The bank, unable to meet withdrawals, fails. The failure spreads fear to other banks. Depositors run on those banks too. The cascade continues until the government intervenes. In a collateral freeze, confidence doesn't collapse in depositors, it collapses in counterparties. Bank A refuses to lend to Bank B overnight because Bank A isn't sure the collateral Bank B is posting is actually available. Maybe that treasury bond is already pledged to Bank C. Maybe Bank C has pledged it to Bank D. Maybe someone in the chain can't deliver when called upon, and the collateral will be seized by a creditor Bank A has never heard of. The uncertainty is fatal. When you can't trust the collateral, you can't make the loan. When you can't make the loan, commerce stops. Not gradually, instantly. The overnight lending market freezes. Corporate America, which relies on overnight credit to manage cash flow, suddenly can't meet payroll. Suppliers don't get paid. Workers don't get paid. The economy seizes. This is what happened on September 17, 2019, when the repo market froze without warning. Overnight lending rates spiked from 2% to 10% in hours. The Fed injected $75 billion in emergency liquidity, then $100 billion, then $175 billion. They kept injecting until March 2020, when the pandemic required even more dramatic intervention. The 2019 freeze happened at a collateral reuse rate of 4.1x. We're now at 7.2x. The 2019 freeze happened when the shadow banking system was $12 trillion. It's now $22 trillion. The 2019 freeze happened when settlement failures were running at 1.8%. They're now at 4.2%. Every metric that indicated stress in 2019 is worse today. And the system's capacity to absorb stress hasn't improved. It's degraded, as regulation has lagged the migration of activity into shadows. Less than 14 days remain before the end of January, when quarterly settlement obligations converge with corporate earnings season and Treasury auction calendars. This period, the last 2 weeks of January and first 2 weeks of February, is historically the highest stress window for collateral markets. It's when the system is most vulnerable to the kind of cascade that 4.2% failure rates suggest is already beginning. At 7:15 a.m. Eastern on Wednesday, the Federal Reserve Bank of New York published its weekly report on the Standing Repo Facility, the emergency lending window created after the 2019 freeze to prevent future dislocations. Usage was $47 billion, up from $12 billion the previous week. The facility is designed for stress. Usage quadrupling in 7 days indicates stress is arriving. While one side fails to deliver, the other side hoards. The entities that understand collateral scarcity best are responding in ways that make the scarcity worse. Money market funds have increased their holdings of Treasury bills by $340 billion since September. They're hoarding the highest quality collateral, removing it from the rehypothecation chains where it previously circulated. Every billion they hoard is a billion less available for overnight lending. Prime brokers, the institutions that provide leverage to hedge funds, have quietly raised margin requirements by 15 to 20% across client bases. They're demanding more collateral per dollar of exposure. The increased demand for collateral, in an environment where collateral is already scarce, tightens conditions further. The largest hedge funds have shifted from net borrowers in repo markets to net lenders. Citadel, Millennium, Point72, the multi-strategy giants, are sitting on cash and collateral rather than deploying it. When the smartest leveraged players in the market choose to hold liquidity rather than use it, they're telling you what they expect to need it for. The behavior is rational for each individual actor and catastrophic in aggregate. Everyone preparing for a freeze makes the freeze more likely. Everyone hoarding collateral reduces the collateral available to others. The system contracts into itself, each defensive action triggering more defensive actions. At 2:45 p.m. Singapore time on Thursday, the Monetary Authority of Singapore issued guidance to local banks on collateral management during periods of market stress. The guidance recommended banks review their rehypothecation chains and verify the location and encumbrance status of all pledged securities. When regulators start asking banks whether they actually know where their collateral is, the regulators are worried that the banks don't know. And if the banks don't know, nobody knows. And if nobody knows, the 4.2% failure rate isn't the end of the stress, it's the beginning. This is what a system looks like before the break becomes visible. The $18 trillion didn't disappear. It's still out there, pledged, rehypothecated, transformed into leverage that exists on no single balance sheet. The treasuries are real. The collateral chains built on them are real. But the chains have stretched so long, crossed so many jurisdictions, and reused the same securities so many times that untangling who owns what and who has claims on what may not be possible until the chains break. Some will look at 4.2% settlement failures and see a system handling stress. We'll trust that the Fed's facilities are adequate. We'll assume that if something serious were wrong, it would be front-page news. These are the same voices that saw nothing concerning in 2019 until repo rates hit 10%, that saw nothing concerning in 2008 until Lehman's bankruptcy was announced, that see nothing concerning in shadow banking because shadow banking is designed not to be seen. Others will read the BIS working paper. We'll track the DTCC settlement data. We'll notice that collateral velocity has doubled while the shadow banking system has nearly doubled. We'll understand that 7.2x reuse means 7 counterparties believe they have a claim on the same securities, and 6 of them are going to be disappointed. The informed are not predicting when the freeze happens. Timing a collateral cascade is like timing an earthquake. The stress accumulates invisibly until it doesn't. What the informed recognize is that the stress indicators are flashing, that settlement failures are at records, that the Fed's emergency facilities are seeing elevated usage, that the smartest leveraged players are hoarding liquidity. This is not financial advice. This is not a recommendation to exit credit markets or hoard treasuries or take any position based on settlement statistics. This is simply an observation about what happens when $18 trillion moves into shadow structures, collateral is reused 7 times over, and the system that tracks it all starts showing failure rates not seen in 3 decades. The Treasury bill in the database looks the same as it did last year. Same face value, same yield, same government guarantee. But that Treasury bill might be pledged to 7 different counterparties who all believe they own it. When one of them needs to sell it, 6 will discover they can't. When 6 can't, the chains collapse. When the chains collapse, the lending stops. When the lending stops, credit freezes. 14 days until the end of January. 4.2% failure rates. 7.2 times collateral reuse. $47 billion in emergency facility usage. The numbers are all moving in the same direction. The direction that precedes every credit event in modern financial history. The break hasn't happened yet, but the stress that causes breaks is already in the data. $18 trillion, quietly moved, waiting for someone to ask where it went. When they ask, the answer will freeze credit markets worldwide, and nobody will be able to say they weren't warned.